Welcome to Anupama Rasayan India Limited Q3 and 9M FY24 earnings conference call. Please note that a copy of our disclosure is available on the investor section of our website as well as on the stock exchanges. Please do note that anything said on this call which reflects our outlook towards the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. This conference call is being recorded and the transcript along with the audio of the same will be made available on the website of the company and exchanges. Please also note that the audio of the conference call is the copyright material of Anupama Rasayan India and cannot be copied, rebroadcasted or attributed in press or media without specific and written consent of the company. Today from the management side, we have with us Mr. Anand Desai, Managing Director, Mr. Gopal Agarwal, Chief Executive Officer, Mr. Amit Khurana, Chief Financial Officer, and Mr. Vishal Thakkar, Deputy Chief Financial Officer. I would now like to hand over the call to Mr. Anand Desai for his opening remarks. Thank you, and over to you, sir.
Thank you, Advait. Good evening and welcome everyone to our Q3 and 9 months forward FY24 earnings call. Since we are connecting for the first time since the start of the year, I wish you all a happy new year. Let us look at the broader landscape before we dive into the industry and company in particular. An uncertain global economic environment that we were facing through 2023 is likely spilling over in 2024 as well. Despite the inflation cooling off and a hope of demand recovery, the geopolitical issues are keeping the world on tenterhooks. On the industry front, the agrochemical sector continues to witness demand issues across the nations. This, coupled with falling raw material prices, is having double impact on the revenue and growth for the industry. It appears that remain a year of low degrowth for majority of the agrochemical companies. That said, there are green shoots, and as we speak, raw material prices are stabilizing and demand scenario is picking up in some pockets. Strategically for Anupama, the higher growth in polymer and pharma sector is expected to compensate the tepid growth in the agrochemical section. On that note, let me shed some light on the performance of the quarter, after which we can move on to the business updates. Our total revenue stood at rupees 298 crores with a YOY degrowth of 23% on a consolidated basis, whereas for the 9 months, our total revenue stood at rupees 1,092 crores, posting YOY degrowth of 1%. The challenging industry landscape has been responsible for this growth, along with Q3 being the end of the year for some of our customers, which meant these clients were off-taking only minimum as per the contract. As we have pass-through model for the pricing, we have been able to maintain our EBITDA margins at 30.1% on a standalone basis, and for the quarter, and 27% on consolidated basis for the same period. Before I conclude, I would like to draw your attention to one of the most important initiatives at Anupama, and which is very close to my heart. As an organization, sustainability has been deep-rooted in our operations and thought processes. We have been striving to build long-term sustainability initiatives and integrate it in our business. On that front, I am pleased to report that Anupama Rasayan will be investing rupees 59 crores towards setting up a hybrid power plant of 9.6 megawatt. When I say hybrid, it's a combination of wind power and solar power. That is 5.6 megawatt of wind power and solar power will be 4 megawatts. This initiative will help us reduce our energy cost of approximately 15 crores per year. These investments in solar would now translate to electricity consumption for green energy in coming years. I firmly believe the industry will witness revival from H1 FY24 based on the LOIs and the contracts we have signed in 2022 and 23 and strong product pipeline which gives us a reasonable confidence for growth in FY25. Before Amit Bhai and Vishal Bhai discusses the financials in greater detail, I would like to call upon Gopal Bhai to share our business updates. Over to you, Gopal Bhai.
Thank you, Anand Bhai. Hello and good evening, everyone. Welcome to our Q3 and 9 months FY24 earnings calls. I will quickly share key business updates and then hand over to the call to Amit Bhai to discuss financials. Starting with new products launched during the quarter in FY24, Q3 FY24, we commercialized 6 new molecules, 4 of which are in coordination series, and the remaining 2 are from signed LOI and contracts. In 9 months FY24, we have launched in total 11 new molecules, all of which will ramp up gradually in FY25 and FY26, resulting in a positive impact on our revenue in coming years, as highlighted by Anand Bhai earlier in his opening remarks. On the contracts and LOI side, I am pleased to share that during the quarter, we signed a letter of intent worth $61 million, that is INR 507 crores, for next 9 years. This is the one which is with a leading Japanese chemical company to supply new age polymer intermediate. As per the agreement, the supply will commence from 2024. This product will be manufactured in our existing as well as our new multi-purpose manufacturing facilities, and the molecule will be utilized as an intermediate for thermoplastic polymer, which finds its uses in structural materials in aerospace industries, semiconductor process material, electric and electronic devices, and high-performance industrial machineries. One of the key things to note here is that we are fully backward integrated for this molecule. This is in line with our strategy of expanding our polymer portfolio and deepening our presence in Japan. We've been able to expand our existing customer wallet as well as onboard a few new clients. With a market such as Japan that is complex and tough to crack, we have successfully made inroads over the last few years through our relentless R&D effort as well as investing in talent. To ensure better control, we have also incorporated a subsidiary in Japan, which showcases our focus towards the important geography. I firmly believe that our Japan business will see strong growth in the coming years and will likely to become a major business center for Anupam. I'm also proud to inform you that Anupama Rasayan won CII 3R Award for Best Industry Practices for Managing Our Own Waste. This award reinforces our belief that sustainability is not just a choice, but a business imperative. It highlights our commitment to environment sustainability and responsible business practices. Over the past few years, we have worked tirelessly to implement innovative and effective waste management strategies, and the award validates this effort. With this, to take you through the financial highlights, I would like to hand over the call to our CFO. Over to you, Amit Bhai.
Thank you, Gopal Bhai. Good evening, everyone, and thank you for joining us on the call. Let me take you through the financial highlights for the quarter, and then we'll hand over the call to Vishal Bhai to discuss these in depth. Before I get into financials, let me share an update on our recent fundraise. During the quarter, the company issued shares worth rupees 180 crores and warrant worth 370 crores to promoter and institutional investor respectively. The company has already received rupees 272 crores through equity issuance and first tranche of warrants. Of these, we have already utilized rupees 198 crores towards debt repayment till date. We have a sharp focus on deleveraging the balance sheet with an ambitious target of being long-term debt-free company over the next 18 months. Coming to capex for 9 months, we have incurred rupees 381 crores out of the rupees 670 crores capex announced. The balance capex will be incurred in next 2 quarters as per plan. At the end of Q3 FY24, cash and cash equivalents on the books as of 31st December 2023 stood at rupees 577 crores, which is sufficient enough for the planned capex. With this, I hand over the floor to our Deputy CFO, Vishal Bhai, who will take you through the financials in detail.
Thank you, Amit Bhai. Hello and good evening, everyone. Thank you for joining us here today. I would like to share some key performance highlights for the quarter and 9 months ended 31st December 2023, and then we'll open the floor for question and answers. Before I proceed, I hope you all have had a chance to go through the detailed presentation and the results submitted to the exchanges and also uploaded on our website. Kindly note, our numbers for the quarter are on consolidated basis, and they also include TANFAC numbers. Let me first discuss the consolidated financial highlights for the quarter ended September 30th, 2023. Operating revenues for Q3 FY24 was at 296 crores as compared to 392 crores in Q3 FY23, down 25% YOY. EBITDA, including other income, was at rupees 81 crores in Q3 FY24 as compared to rupees 108 crores in Q3 FY23, again resulting in a degrowth of 25%. However, this would translate into an EBITDA of 27% EBITDA margin for this quarter, which is similar to the EBITDA margins that we have been seeing in past as well. Profit after tax was at rupees 26 crores in Q3 FY24 as compared to rupees 554 crores in Q3 FY23. Coming to the 9 months performance, operating revenue for 9 months FY24 was at rupees 1,074 crores as compared to 1,122 crores, down 4% YOY. EBITDA and including other income stood at 306 crores as compared to 298 crores in 9 months FY23, growth of 3% YOY. This would translate into an EBITDA margin of 28%, which has been consistently in the range that we have been reporting in the past as well. Profit after tax was at rupees 127 crores as compared to rupees 144 crores for the 9 months FY23, a degrowth of 12% YOY. For 9 months FY24, our life sciences segment contributed 91% of the total revenue, and the balance 9 came from the specialty chemicals. Our top 10 customers contributed 77% of the total revenue, and there are total 23 products that we provide to them. With that, we'll open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and good evening, everyone. So my first question is from the LOIs and from customers' perspective. So we have seen that last quarter was an exceptional quarter in terms of the demand scenario. What are we looking at in the current quarter from the orders perspective? And if you could just let us, give a bit about the LOIs as well, whether we are on track in terms of the customer engagements, what they had anticipated earlier, the order or volume would be for 2024, or they are slightly taken aback given the current situation and they will be in a wait and watch situation. So your comments on this. Thank you.
Yeah. Hi, Rohit. This is Vishal. I'll just take your question on this. And Rohit, if you look at in terms of the LOIs and contracts and the kind of buoyancy there, I would suggest that the LOIs and the kind of engagement that we have been seeing with the customer has been robust, especially when we're talking about a long-term kind of numbers. Just
તમે જે વ્યક્તિ સાથે વાત કરી રહ્યા છો એમને તમારા કોલને હોલ્ડ પર રાખ્યો છે. કૃપા કરીને.
Hello.
Hello.
Oh, I'm sorry, my line got a little disconnected. Apologies for this. So when we're talking about the LOIs and contracts, the engagement on the customer side on the LOIs has been strong. And their interest with us has been quite robust. If you look at that, that's also the reflection. If you see in terms of this quarter also, the quarter went by. We signed one LOI, and we believe that there are further more interactions that are there, and there are quite positive interest that we are seeing from the customers for the longer tenor demand. Now, coming to the shorter tenor demand, the shorter tenor demand is basically, as we had mentioned, and as you are also aware, that the market has been pretty, subdued for this quarter and the next, and we see that the next quarter will be also pretty subdued. So I think the question that if you are asking on the demand side, short term, for this quarter, next quarter, we may see a little bit of a tepidness, but going forward from the H1 2025, we should be able to see that the revenue should start coming up.
Sure. That's helpful. Yeah. Just a light question to that. In terms of, so we were earlier guiding FY25 will have our base business. Addition to that will be LOIs and plus fluorination. So how are we looking in terms of overall growth for FY25 and FY26? If you can just give broadly a sense of that. Thank you.
So yeah, you touched upon it rightly that if you look at the demand from the revenue contribution from the LOIs and from the pharma sector, should start pharma and polymers should start giving a meaningful growth for us in FY25 and FY26, and that should add to the growth. And the base volumes which are from the historical products and others should give the stability to the demand, stability to the revenue, and so I would put it that my historical products will give me a stability of my revenue, and the pharma and the polymer and the Japanese market should give us additional volumes for the growth in FY25 and 26. And 26 again, the historical molecules should also give limited should give some contribute to some bit of a growth as well, as we see.
Sure, that's helpful. One last bit, and then probably I'll just come back in the queue. So
no problem.
That,
please.
Given that we have raised the money and we are repaying the debt, what is the kind of interest saving that we are expecting in FY24 and if possibly in FY25?
Interest saving for FY24 will be limited because if you look at it, it will be practically for a quarter. But FY25, the number should be around 24 crores of saving on the interest side. This is the estimate that we have for 2025.
Sure. This is helpful. Thanks a lot, and best of luck. I'll come back in the queue. Thank you.
Thank you. Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah. Hi, sir. Good evening, and thank you for the opportunity. So my first question is on the working capital side. Just wanted to understand, has there been any improvement on that front?
Okay. So Krishan, if you look at on an absolute basis, we have seen that there has been an improvement in working capital. Has it been as where we wanted to? The answer is no. But is it on the right direction? Answer is yes.
Okay. So would you be able to kind of share the number of days at 9M FY24 or not possible?
I would prefer that we have not reported that, so I would prefer if I don't mention that. But in the next quarter, I would definitely share that with you, if that helps you.
Yeah. So just going by your target, which you had about 180 to 200 days by end of FY24, are we still on track?
I would have to say no, we are not on track on that. But directionally, yes. But in terms of quantum, we don't see that number being achieved, especially in the context of the kind of a demand downturn demand compression that we have seen. And tepidness that we have seen. So because it has double impact, the liquidation of the inventory reduces, and also my base number is also lower to that extent. So I have a double whammy on that. So yeah, would we be in the range that we have mentioned? Probably not. I would say that.
Okay, noted. And in terms of I think you mentioned about our gross and net debt position at 9M FY24 in the initial comments. Did I miss that? If yes, could you please reshare?
We didn't mention that. I can share that what we said was that we have repaid a loan of 200 crores as on today, I would say, because the money came in at the end of the quarter. So as on date, we have repaid 200 crores of long-term debt from the money that we raised, which is of the warrants and the warrants and the preferential shares. Today, my long-term debt would be shade less than 400, and I think once we do this fund, the balance amount comes in, we should be going to zero debt in terms of long-term debt. Of that 400 also, the 90 crores is my promoter debt. So if you look at the external debt, is around about 310 crores only. And from the balance funds that we are raising, we believe that we should be, at that time, we should be like zero long-term debt, especially on the net basis. Because if you look at my cash, today I'm sitting on a cash of around 570 crores today, as on 31st December, so not March, my bad.
Okay, so is there any short-term debt as well on the books?
Yeah, there is working capital debt.
Okay, no problem. Yeah, and if I may ask one or two questions, if you may.
Go ahead, no problem.
So, yeah. So I think, firstly, congrats on the LOI that you signed in this quarter. So just, just one suggestion, probably in the slide 20, whereby you have mentioned, signing quarter. If you could also mention, revenue contributing quarter for all the LOIs and the contracts whenever. So, it would be easier for us to kind of track that.
So, Kishan, the only challenge is that many times it's a fine line between two things. One is being prudent in terms of forecast, and two is also guiding the numbers and forward-looking statement. So that's the main reason why we have been avoiding this, because it can tantamount to forward-looking statements, and that may not be a very helpful situation to be in. So
understood.
For that,
yeah, I get your point. But directionally, would you be able to kind of share the possible revenue generating quarters for the last 4 LOIs that we have signed in this fiscal? I mean, just a ballpark estimate would do, not exact number.
See, I think one of them we had said that we would be commercializing it in the same year itself as we will also say. This is the last one, and that would happen. Couple of the other one we had also said that it would start from 25 CY and one will be 26 CY. So largely in next 2 years you should see commercialization of most of the molecules that we have talked about.
Understood. And last question from my side, just a more fundamental question. So, when you mentioned these LOIs and contracts, so is it a must for your customer to purchase a cumulative contracted amount? I mean, if, let's say, if there is a prolonged weakness, like we have seen since last couple of quarters, the cumulative offtake could be lower than the stated amounts. Is that understanding correct?
So, see, there are 2 numbers in this. Typically, when you sign a contract, you will have 2 numbers. One is the minimum offtake guarantee. It's called MGO, minimum guaranteed offtake. And 2 is an estimated number that they would want to say that this is the plan that we have and this is the base case scenario on which we are contracting. And then there is always an upside to that. Now let's look at it in this manner that let's say this is a 5-year contract. So do we expect that at the end of the 5th year they will stop buying from us? The answer is no. Typically we have seen that the contracts roll over or the demands continue because they have moved from Europe or from a high cost to the low cost countries like us. After that, do we expect them to move to any other places? I do not see that as a big possibility. No doubt there is always a possibility because they're contracted for 5 and they can, but historically we have not seen them doing that. And there is a logical reason to it also. Because we as long as we don't make a big mistake, they would continue to roll over the contracts. So the question that you are asking is that would you really, that would the cumulative demand be the same or not? See, typically, if you see what has happened in last 2 quarters has been that the inventory liquidation is happening at the customer side. So is there a demand destruction? I think demand destruction is not the larger contributor of the tepidness in the demand, but it's more the realignment and reallocation of their inventories and lightening their balance sheet, which is the reason. So in all, to answer your question, we don't see it significantly impacting the overall demand.
Noted. So I think my question was more to understand, let's say a 5-year revenue trajectory rather than, anything else. I know that you have been rolling forward a lot of products since the inception of the company. So that point is very clear. It was just to understand, let's say, standing here, what is the growth outlook for the next 5 years? So that was the reason for understanding. But yeah, I think it is very, very clear. Thank you and all the best, sir. Yeah.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Thank you and good evening. So I just had a few questions on the numbers and then some thoughts on the business. So can you split the 26% decline in standalone revenue into volume and price?
So this is largely driven by the volume rather than the price. Price has been pretty much stable to my mind. So if there is any contribution, it's not anything significant in terms of price. I think the large part of the thing is on the volume side. And
what is the share of exports and contract revenue in 3Q?
So exports is around about 55 to 56% for the quarter, and balance is domestic. Largely, all the demand is, as we said, that large part of our demand is more contracted in nature.
Okay. So if it's all contract revenue,
contract and contract equivalent. Huh? So because there are some ones where we don't have a contract, but we are rolling demand continuing for last so many years. So that's also.
Yeah, understood. So in the context of the customers deferring their purchase because of their issues in terms of liquidating inventory, is there a possibility of you getting these volumes delivered say subsequently in FY25, or is that something which is pretty much lost business? How does it work in your contracts where LOI is equivalent?
See, so that's where we think the minimum definitely we will get it, and even if you look at it this quarter also they did pick up the minimum volumes, right? So that will happen. The upside, and if you are asking for the delta on this, typically see our sense is that this is more liquid inventory movement and not too much on the demand side. So if it is inventory movement, as and when they stock up the inventory back, they can. But if they continue to run with this same level of inventory, then you will see that demand doesn't come to us. Still, the demand that inventory is stocked up to the level which they were carrying earlier. But other than that, we don't see too much demand going off the expectations.
Okay. So if you were to map your capex and the booking of revenue against your LOIs and contracts due for delivery over 24, 25, 26, how much of that whatever the customers are expected to take delivery of in terms of new contracts is possible to be delivered from existing assets not part of the capex, and how much of that has to wait until the capex is completed, and when does that capex get completed and do those assets start commercial operation?
So the first thing is, if you look at my capex, we had undertaken a plan for 670 crores of capex. We have done capex of 381 crores. We did around 150 crores of capex in this quarter, so the quarter that went by. And we believe that in next 2 quarters, we should be able to do the majority of the capex that has been planned out. So one plant we should be able to get operational this quarter, and the other 2 in subsequent quarters. So if you look at it, we will have enough capacity for us to grow for next 2 to 3 years. We don't see that capacity being a constraint for our demand, for servicing our demand from here on.
Yes,
so So there is enough and more that we can service for next 2 years.
So the question, what we are trying to understand is, you have some, because in some contracts you mentioned they can be delivered from the existing assets, and some of them are possibly from the new assets. So how much growth can you get, or how much additional revenue in rupees crores can you get from the existing assets, say, over FY 25 and 26?
So as we had said in the past also, we can do a revenue of 1,700 crores to 1,800 crores from our current capacities. So to that extent, we have enough capacities. Two is, if we were to look at from the LOIs and contracts that we mentioned, even the LOIs and contracts will take time to commercialize, right? And by that time, we should have the plant. And the ones that we are looking at commercializing it soon, we have factored in the capacities from our existing plants. So to that extent, if the question is that is there any situation where we will have a demand but not the capacity? Probably the answer doesn't look like yes. Yeah.
So the 1,700, this year you are doing about 1,060, 1,100, right? So if supposing you are looking at the existing assets, how much of this 1,700, 1,800 can you deliver, say, in the next 2 years, assuming normalized demand environment, and once the inventory situation is stabilized? And on that, what is the kind of delta we can expect from the new contracts, say, over the next 2 to 3 years? Whatever, your order bank to numbers you can give, so that, we are able to map the growth to existing assets as well as the capex, and, it's related to the order book. That's the angle from which I'm asking that.
I didn't get your question right, but if I were to just put the question in my words, what you are saying is that what is the demand, what is the revenue that we can subscribe through the capacity that we have created today, and what is it that will happen from the future, right? Future cases. And the two is the question that you are asking is that from the LOIs and contracts, how much are we looking at going from now, and what is the kind of, is there any constraint because of the current capacities which are not designed for the LOIs and contracts that we have signed? Is that the question you are asking?
No, I'm speaking more from the demand side. Since right now demand seems to be the issue even for contracting business. You have a potential. See, maybe over 3 years you can achieve the point. The point is, what can we realistically expect from existing assets and the new assets, given a certain stable environment, in terms of your reading about the appetite for taking intermediates and final products from your manufacturing facilities in your CSM business?
So Ramesh, I will put it in a very simple manner. That my demand growth we expect from next year onwards to be reasonably strong, and from 25 onwards we should be able to see a reasonably strong demand growth, and that should continue for the next 2 to 3 years. Looking at the kind of the order pipeline and the product launches that we have. If you look at the orders, the number of products that we have commercialized in this 9 months is 11 products that we have commercialized, and these itself has a reasonable market size, a reasonable demand size. And if I add to that the products that we are expected to launch in next 12 to 18 months, we see that there is enough that we can look at from the growth. This is 1 year where you will see that there is an exception in terms of the growth, but going forward from 25 onwards, you will see that the growth will be robust.
Yeah, so that comes to the final thought process. What is the short-term debt on your books, and on the incremental business you can do over the next 2 to 3 years? What will be the kind of net working capital days you will aim at? Because right now that seems to be the challenge for you, right? So because that has a definite impact on the additional cash you need to raise. So if you can throw some light on your thoughts on what will be the incremental net working capital, and what is the current short-term debt on your books?
So Ramesh, let me answer it in a very different manner, and because this is not the quarter where we are releasing the balance sheet, so I will try and be a bit more cautious on the numbers that I speak up. But let me give you one or two items. Is that, do I need significant external capital for my current growth? Answer is no. In fact, we are repaying the debts. Okay, so that's one part of the question. Now the second part of the question is that coming from the working capital side, yes, working capital has been a bit more sticky than what we had anticipated and planned for. For the management, this is one of the topmost focus areas for the management to optimize and be more focused on this parameter for us. However, the moment we see that the cycles start moving, which is where we see that in the next year we should be able to see the cycles moving. We should be able to see that the trajectory that we had been envisaging and the trajectory of the working capital that we have been focusing on should be playing out. It has been slower in this year, unlike what we had anticipated, but the focus is significantly strong on this parameter of the business.
Thank you. I'll join the queue. Thank you, and wish you all the best.
Thank you. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Madhav Marda from Fidelity International. Please go ahead.
Hi, good evening. Thank you so much for your time. A couple of questions. First one, basically for our agro portfolio, where are we in the destocking cycle? Because as we understand, the impact really varies by the portfolio that each of the companies has. So from our portfolio perspective, do you expect the destocking to end largely by Q4, or do you think this impact could extend into Q1? That is my first question.
Sure. So, Madhav, the way we are seeing it right now, I think what you rightly said is that Q4 maybe the end of the destocking period, I would say. We anticipate that the stabilization of the demand should start from Q1 FY2024-25, and it should only consolidate as we go further.
Okay. And I think you spoke about some newer portfolio coming from the pharma and the polymer side. So could you give some sense in terms of how big these opportunities can be, and if you could just share any how much of a growth can these contribute in FY25 for us, and how many molecules are these across how many customers? Whatever color you could share will be very helpful. And are the margins better here, or are they similar or lower compared to our existing business?
So let me say that, so Madhav, I'll take it into 2 or 3 parts. Pharma and fluoro will be the segment which should contribute to a significant part of our next year's growth. And the size of that is reasonably large, but I would tend to be cautious on the numbers when I speak on terms of, because it's a forward-looking number, so I would try to be avoiding that. But you can say that the pharma should get into double-digit contribution, and so would polymer be in the 15 to 20% range that they should be contributing to. Polymer and other specialties should contribute around the 15 to 20% of my portfolio in the next year, and pharma should also be in the double-digit, maybe in the higher teens or above, higher teens that we should be seeing or above. So that's from the pharma side, and if I were to say it. The second is on the margin side. See, these are all products which we are doing as an import substitution. And 2 is we are not into the API side of the play, or N-1, N-2 play. We are more on the KSM side of the play in the pharma side, where the competition intensity is pretty limited there. Because these are all imported from the other geographies, and hence we have a strong ability to have a reasonable margins that we can expect from that. Second, also I'll say from a strategy point of view, if you look at it, these are all products which we are largely vertically integrated. 1, 2, these are the products where a 2 step before the product may be also getting into agro side of the business. 1 step down, it would be also going into the polymer side of the business. So if you look at it, that helps us in 2, 3 ways. That my backward integration is stronger, and 2 is my volumes are reasonably larger compared to the typical pharma manufacturing volumes that we see. And based on that, along with my technical capabilities and my process optimization, there is a strong ability to have a similar margins that we are seeing in our agro portfolio. And polymer generally is a segment where, because again we are getting into performance polymers and more value-added polymers, where typically the ability to generate margins is pretty robust here. if you look at it from a margin point of view, we feel pretty confident. If you look at it from a portfolio contribution side, pharma and polymer should start contributing. So polymer anyways contributes, so polymer and other specialty contributes double digit, but it should be in the higher teens, and so should pharma be getting into that kind of a range, is what I would say.
Okay, understood. So is it fair to say that as we look at FY25, we are more positive on the non-agro portfolio, which is pharma and polymers, to do the heavy lifting for growth for us for FY25, and agro will be also growing, but the heavy lifting is done by the other two. Is that the right way to think as we stand today?
Yeah. As of now, that's how we are seeing it as of now. Not that I'm saying agro will have a negative, but basically heavy lifting will come from three parts. One is pharma, polymer, and LOIs and contracts that we have signed, which will also ramp up and contribute to the growth.
Okay, got it. Understood. Okay, thank you so much.
Thank you.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity, and apologies for joining the call late, so there could be some questions which may be a repetition. First question on the product launches, the molecule launch. Year on year, we are seeing an improvement here in terms of number of product launches. Just want to understand the timelines of revenue ramp up here. How much time for a typical product approval, and by when we should see a revenue uptick given the inventory situation that we are in?
So product launches, yes, that is something which is happening well, and that is leading to a good volume. As I was mentioning to even the previous questions, it has started contributing, and we believe that this should add the large part of my growth would come from these products. But Ankur, if you can, if there is anything that I have not answered, I'm happy to. Please, if you can ask me anything.
Sure. So you are saying these new launches have already started contributing to our revenues. If you can share, maybe on a 9-monthly basis, what is the revenue share from the new launches, maybe the products which we had launched over the last 2 years, 1 or 2 years, what will be the share right now from them?
So new will be, so if you look at last couple of years launches and their contribution, which will be in the teens of my total revenue, and maybe on the higher teen side. And we believe that number will only increase if I look at the cumulative contribution, let's say 2 years to next 1 year. So next the launches that would have done in last 2 years plus 1 year going forward next year. I think it should be in 20s that would start contributing in terms of my revenue.
Sure. And these launches, these new products are largely maybe a very different segment or a different product, different molecule that we are doing, or could be a sort of improvisation of an existing one.
So Ankur, if you look at it, typically we have gone by the strategy of the tree, as we try to tell, that typically we work on the product tree basis, and these are all molecules largely coming from where we have built on the capabilities that we have and the supply chain that we have created, right? And then we go forward integration, forward side, typically where we try to capture more and more opportunities. As I was mentioning, even when I was talking about the pharma side also, that they are products where we have been historically having strengths N-2 or N-3 of that product, because that's typically where that product may be going into the pharma agro side also, maybe going into the polymer side also. So that's where we go from. We build that strength from the whole value chain. That's one part of the game. And second is chlorination is definitely now coming up and playing well, and you will see that the next year the contribution of chlorination will be significant. Even today it is reasonably strong, but next year you will see it to be in 20s, if not more. So what we are doing, if you look at from a strategy point of view, is building on our capacities rather than trying to do multiple things at one point. You may see that the application is going to pharma, the application is going to polymer, the application is going to agro, but at the base, the the strength that we have of our technical capabilities, our supply chain, and the value trees that we create is what really is driving the whole strategy.
Sure. Fair enough, Vishal, right. And just, from a revenue mix perspective, given that many products, if I heard you right, are getting into pharma polymers, while currently our business being slightly more, tilted towards agri. How do you look at revenue share over a 3-year window or a 5-year window coming from agri, pharma, polymers, and maybe some other, segments?
So I'm please take it with a lot of caution and a bit of caveating, but my estimate is that pharma should be contributing in 20s, and so should polymer and other specialties should be in that range, and the balance should be coming from the agro. Agro will continue to be the rock bed in terms of our demand stability and our revenue, and they would grow over the next few years. But pharma and polymer, other specialty including polymer, should contribute a meaningful volumes as we go from here.
Sure. That's helpful. Another thing, on the capex side, we had announced around 6.5 billion, 650, 670 crores of capex. Will this capex be suffice for us to reach the optimum level from an LOI, that we have signed and the revenue ramp up? Or probably there could be more surplus left for us to ramp up the revenues here?
Largely, if you see, we would be fairly done by that. So today, whatever is our plan in terms of revenue that we want to reach in next 3 years odd, I think this capacity should be sufficient. Maybe there may be some debottlenecking and other, that we typically do because with the change in the product mix or otherwise we will do that. But if you look at the large capex program, I think we should be fairly comfortable that we would have covered for that.
Okay. And last thing here.
I'm sorry to interrupt. May I request that you return to the question queue?
Sure. No.
It's okay. Let him go with the one now. Where's that he started? Please go ahead.
Okay.
Just last bit on the revenue deferrals that we have seen. Basis your discussion with the client, any timeline you want to share when we should see a uptake? Because as I understand it varies a lot across the product chemistry, maybe even geography and client. So your last comment on that. Thanks.
So Ankur, the thing is that we see that by the Q1 25, we should start seeing the growth coming back, and 25 should be FY25 should be a reasonably good year in terms of our growth, and we see that the momentum should continue. Again, I'm adding back saying that my new molecules that we have launched, the LOIs getting commercialized, all that is going to really add to this, and that's where it gives us a reasonable amount of comfort that the 25 should be looking good.
Okay, great, Vishal bhai. Thank you and all the best. Thanks.
Thank you, Ankur.
Thank you. The next question is from the line of Meet Vora from MK Global. Please go ahead.
Yeah, thanks for taking my question. I just had one question. Vishal bhai, we are seeing a very high uptake in our gross margin in this quarter. So if you can explain what has led to this jump in gross margin?
So Meet, as I've been also in my past, in our past discussions also, we've been always suggesting that the way our business model is structured, that we look at it at the EBITDA levels, because not only my raw materials but my overheads and my utility costs and everything is a pass through. So typically, whenever you see us at the EBITDA levels, because that's a more representative number. Because there are products where you may have a higher gross margin and a higher overhead, and there may be products where we have a lower gross margin but there will be lower overheads, and that compensates with each other, right? Because at the end, the customer is willing to pay a particular margin to us on an EBITDA or a PBT basis. That's how we've been building the business. So today, whatever you are seeing in terms of movement of a gross margin is largely the product mix. That there are these products where there is lower RMC but a higher number of steps that we will be doing in this product, and that's the reason you will see that the overheads are higher here, and that is compensating one to other. So if you look at on the EBITDA side, you will see the similar numbers that we have.
Sure. So that's because of product mix. Yeah. So that was my only question. Thanks and best of luck.
Thank you. Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the follow-up. Just two questions. One is in terms of our CapEx guidance. So how would the CapEx stack up in 24, 25 and FY26?
So CapEx, as I said, the large CapEx will be done. 670 should be completed by in next 2 quarters. So let's say by the first half of FY25, we should be done with the 670 crores of CapEx. And then it will be more a maintenance CapEx or a more that kind of CapEx that you would see for the year till now, because we have not done anything further for me to guide on any CapEx for now. If there are any, I will come back to you in the subsequent quarters.
Sure. This is helpful. Second question is, you all just now gave a direction on how FY25 will look like. So is it that FY26 should see a quantum jump in terms of our performance, given that most of the LOIs and the newer contracts will come into fruition? Along with that, the fluorination piece will also be operational and functional. So could there be a step jump which can be expected from FY26 perspective? Thank you.
So Rohit, first a little lighter vein. I would love that whatever you say comes true in terms of yes. See, that's also, if you see all the factors are playing there. The question is that the timing and the stuff. So right now I would not want to crystal gaze on the 26 in that specific manner. But what you're saying looks to me also the driver for the demand for the growth here, because there are multiple vectors which are coming together for us on the growth side. So I see you, but right now I don't want to put a number to it. But yes, I am also very very bullish on those parameters.
Sure. This is helpful, and thanks a lot. Best of luck.
Thank you.
Thank you. Due to time constraint, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Thank you all for joining us today on the call. I hope we have been able to answer all your questions. If we have missed out on any question specifically, or if you have any further queries, please reach out to our IR partner, EY, and we'll be able to get back to you offline. Thank you very much, and have a good day. Cheers.
On behalf of Anupama Rasayan India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.